If the outcome that the people want is income, buying your own home is the furthest place from that. Buying your own home will never give you income. I'm like a massive advocate for rent vesting.
I call Jack, and this is the problem with the advice that you're giving to the public. Most often it's incorrect.
Oh, mate, the PPOR owner-occupier thing's in the bin.
I think that information is misinformed. They then go and sell their primary place of residence on that advice and buy in Darwin.
If I go and listen to some it's crypto advice and I do it, it's not the bloke who spruiked the advice's fault, it's mine.
Jack Henderson is one of Australia's most polarising property investors.
Jack is a serial property investor. He started in 2020 and has built a property portfolio of 26 mil by the age of 26.
Today, he reveals the blueprint he used to break the 30-year mortgage trap.
Don't you think that's dangerous? Like, to be a financial planner, you now need to go to university. It really concerns me.
And there's a lot of other companies out there now that are pumping markets that are You can't tell me that investing in Darwin is a good place. It's not. So you imagine if you had an extra $200,000 to invest every year over 30 years. Now, you got my attention when you razzed on me online. I was in the mirror sparring.
You're listening to the Folio Property Podcast. I'm Reece Bettle, and I'm here each week with my co-host Lachlan Delahunty. Lachlan, we caught up at the back end of last year, and we said we want to go one step further in 2026.
More guests, better guests.
More guests, better guests. And we wrote out a bit of a list on who we wanted onto the podcast, and this man with us today was top of both our lists. So
there you go.
Jack Henderson, welcome.
Thanks for having me. You got my attention when you razzed on me online. So there we go. I got it sent to me, I reckon, about 100 times.
Yeah, right.
Like, mate, do a react back to him. I was like,
I was waiting for it. I got the follow very quickly, and I'm like, this will be great. Get the boxing gloves on, and we'll go for it.
Look, you're a big character. You know, you walked in today. Your outfit's outrageous. You got the
Year of the horse.
Negative
Legit,
gearing.
An Asian friend of mine got me this.
That's the year of the horse.
Negative gearing hat on. I mean, was there a moment you was it like a pivotal moment that you were like, all right, I'm going to lean into this?
Yeah, so I've always been different. Like growing up, I was always sort of similar. I mean, I was different to what I am right now, but I was always different from the kids I grew up with. But I was different in a bad way growing up. I was always the mischievous one. And I was always the one getting my friends in trouble, and their parents didn't really like me. So it was bad. And then, as you start to mature and you work out, like, if I keep doing this shit, it's going to go one way and it's not going to be the best way. Or I can use this energy and this passion that I have for doing bad shit and getting into trouble and put it into something that I love. And fortunately, I found property. And when I got into the industry, I then sort of blended. I was dressing like you guys, I was like a little bit more conservative in nature. I was wearing suits. I was in the eastern suburbs. I was trying to fit in, and it wasn't me. And then as I started to make more money, was less reliant, because I was working for another company then. So I was like reliant on sort of fitting in with them. I started to make more money and be less reliant on other people. And then I found, well, people just like me because I am different.
Yeah. And I've listened to a lot of your content in the lead up to this interview, and you're all through my feed, just through the algorithm anyway. I think one of the things you said was the core message is correct and true.
Yeah.
But the way it's delivered is, that's going to be an extra level of who I am, just to, get the audience attention.
Yeah, and it also attracts the right type of people, and the people who want to use our business and resonate with me, and it like detracts the people that are not going to use us. Yeah. And the more polarizing you are, let's use Trump as the example, regardless if you think he's good or bad or right or wrong, there are diehards that love him, and there are people that hate him and want him dead. But because he is so divisive, that's what builds brand.
Like, how would you summarize a property spruiker? Because this is the I guess the big question is, like, how are we not property spruikers? Like, we could be perceived as property spruiker ourselves.
For sure.
We're talking property.
Yeah,
so.
I mean, we spruik property as an investment, right? So we do spruik things. I suppose you either spruik the right or the wrong thing, though. So the reason I'm so passionate about the way that we invest and the way not to invest is because my parents got burnt by these pricks. When I was young, they bought the off-the-plan apartment. I did a full YouTube video on this the other day, and they bought a house and land package in Truganina in Victoria. Both shitholes. They lost money on both of them. They held one for 13 years and lost money on it, which is unheard of. If they would have bought just the house next door to where they lived, they would have tripled or quadrupled their money in that period of time. So I've seen firsthand what happens when you get it wrong. Now, don't get me wrong. If they continued to hold that property, the apartment in the Sunshine Coast, they probably would have made money now. But to not make money for 13 years, that's not a good investment. They made money because COVID, the printing machines were out, and all of a sudden everything grew in value,
everything
right?
goes up, right? Yeah.
So I've seen firsthand what it can do, and it's not just the monetary impact that it has when you make the wrong investment. It's also then the mental impact. I try to do something, it didn't work, and then they just blanket rule property investing does not work. right? That's what happens.
100%.
So my strategy and the kind of properties that I buy and the stuff that I talk about, and this is why I'm so passionate about Perth as well. Perth has made money recently, no doubt about it. I didn't make a lot of money because I wasn't invested in Perth. But to invest in a location that has been very choppy for the 20 years prior to it, in my eyes, is high risk. I'm not saying you're not going to make money there, but I'm saying if the aim of the game is to not lose money, you just want to make sure you invest in a market that is consistent and doesn't have reliance on one industry, for example.
But obviously, like, absolutely specialisation, there's markets within markets, and you can make, through renovation or subdivision, even in a flat market, you can make really good returns.
Sure.
But if you look at typically where people make their wealth is when you see a macro market increase quite significantly. In Perth, 80%. Adelaide's almost 90% since COVID. New South Wales broadly, probably sub 40%, 30 to 40%. Newcastle and Sydney.
Yeah, give or take.
So if I was looking at that, and obviously you can pick those markets, I'm sure you've got examples above that.
Yeah.
Is it a silly tactic to just double down on one market that's potentially probably underperformed in comparison to the rest of the country?
Not really, because how long of a time frame are you investing in? Since COVID, 80%, mad. I'm investing for 30 years. Do I think a building in Paddington's going to outperform in a house in Bunbury?
Over the long term?
I'll play in my head 10 out of 10 times, right? So that's how I invest. I will never sell. I've never sold one of my assets other than one office in Paddington, which I didn't sell, but I exited a business partner and I had to sell it.
So do you think that strategy works obviously for yourself and your type of client, but that certain strategy wouldn't be the best for, I don't know, mum and dad investor or someone who's just starting to scale a portfolio?
Well, it depends on the kind of person they are. Because right now, there's no one that can say to me, I know this market's going to grow by 30% or 40% in the future, because there's just so many variables that we don't know, right? Like COVID was an anomaly because they printed a load of money.
Don't you think that's our job as, I guess, a leading voice in the industry, that we should be able to pick national markets based on the data that we track and interpret?
Not really. I mean, real estate as a whole, it has a very good ability, or it has an ability to repeat what it's done in the past. So good markets generally become better markets, not worse markets. Now, how much they grow by per year, when they're going to grow, sure, you can track data, population growth, income growth, supply on market, all that shit. That all matters. But again, I'm not getting in and out of markets. So what something does now doesn't really matter all that much. It's like, do I think that in 30 years' time, the property I'm buying today is going to be worth a significant amount more than it is right now? That's a bet I'm willing to make. So let's put our money into there. Let's continue to earn our day-to-day income in whatever it is that we do, business or your job. And then as that property has some growth, you invest in the next one, and then you invest in the next one. And that's literally the strategy I've used. And I've done all right out of it. And there's a lot of people, again, that have done very well out of doing other things. But I've just seen the flip side of it. And there's a lot of other companies out there now that are pumping markets that are you can't tell me that investing in Darwin is a good place. It's not. Why is anyone buying in Darwin? The only reason Darwin right now is having price growth is simply due to the influx of investors going into that market and the lack of supply that's in that market. As soon as investors stop buying, the owner-occupiers are not going to spend the money that houses are selling for now. Have you ever met someone saying, I'm moving to Darwin? Ever?
Interstate growth's negative, right? So I completely agree with Darwin on that one. That's the one
markets,
that we can agree on.
Mackay,
Townsville.
Bundaberg, all that
Gladstone.
shit. It's like, it's all investor driven.
Yeah. But if you do time and
the vast majority of Perth is investor driven too. Sure, there are certain pockets where owner occupiers dominate.
$2.2 million people in that market. I would beg to differ that it's investor driven.
In Perth?
In Perth.
Yeah, of course. It's a big place too. Yeah. $2.2 million people over half of Australia versus in a city that you're sitting in right now.
Yeah, no, I'm just saying. I think to say Perth's investor dominated
there
is unfair.
There is a lot of markets in Perth that people are not buying there to live.
Oh, okay. Your Bunbury examples, your Geraldton, you won't even know where that is, your Kalgoorlies, potentially, but Perth as a
city,
city, for sure.
I think it's a beautiful place, and you probably will do very well there long term if you invest in the right suburbs. There's no denying that. Yeah. But most people who are investing from the east coast of Australia are not investing in those places. They're trying to get into, what's that just south of Perth? I went and ran an ultra marathon.
Bunbury. Rockingham, Mandurah.
Right down the bottom. Mandurah.
Yep.
I went and
no
ran...
offense, Bunbury people.
I ran and... Oh, I mean, if you get offended, that's on you, not me. I went and ran a ultra down in Bunbury. It was a 205-mile run. And there's all there. There's literally nothing there. And even Mandurah, it's like you drive out of Perth and you go from out this beautiful city and then it's like desert.
That's a growth area. It's a growth area.
It's a growth area, yeah.
AUKUS, they're
Couldn't even
spending
grow
billions of
grass
dollars,
there.
the military, etc. But you made a very good point, and I definitely agree with the wave of properties brokers and buyers agents self-inflating these markets, particularly the regionals, because they can have a huge impact on these markets by going in there and buying thousands of property. Obviously, the business owners are getting in there first, taking their clients there, and then getting artificial inflation in that market.
I agree.
But these buyers agents, they come in different forms, shapes and sizes, and they disguise themselves very differently. Do you think this is a little bit, it probably leans into one of your mates, is it, what's he run, the Buyers Institute? Of
Benny?
just, yeah. It's just producing, thousands of buyers agents that aren't educated, don't know the property fundamentals, know how to market themselves quite well, like you, Jack. And having not done the course, never will, but having staff members that have done the course just tell me the fundamentals of that course is how to get exposure and how to get clients.
Yeah.
No education is on property fundamentals. Don't you think that's dangerous? Like, to be a financial planner, you now need to go to university, you've got to get qualified. We don't have to do that in our space, and it really concerns me.
Again, that's not the BAI's fault. Like, the BAI have produced a course to say, here's how you can become a buyer's agent. Nothing wrong with that. If people use it wrong, that's on them.
But they're out there, like, tomorrow.
That's like saying...
Lockie here, the producer, tomorrow comes out, he's a buyer's agent, and he's given informed advice, almost financial advice on where to invest in Australia. Don't you think something needs to change in the industry?
Yeah, I mean, yes and no. Like, I'm someone who's pretty self-accountable. If I go and listen to some spruik crypto advice and I take it on board and I do it, it's not the bloke who spruiked the advice's fault, it's mine for not doing enough research to work out that was bad advice. Like, we've got these beautiful things called iPhones these days, and it doesn't take much research to work out what's right and what's wrong. So, sure, there can be more regulation, but regulation generally things as well. Like, do you think the financial planning industry is better off or worse off with regulation? It's definitely worse off. There were some things that the minority were doing wrong that they shouldn't have been doing, but now because of all the regulation in the financial planning industry, there's way less financial planners.
And they have to charge higher fees.
And they can't say things, they have to, that's terrible. Like, I think over-regulation is really, really bad. Under-regulation also has its risks, I mean, would I rather over or under-regulation in avionics or aeroplanes? Probably over-regulation, because I don't want to fall out of the sky.
What about asset selection? Like, what are some of the key fundamentals you look at in an asset?
One of the main things is historical growth of a location.
We're looking for north of 6.5%, thereabouts?
Yeah, I mean, the Australian average is just under 7% compounding. If you're doing better than the Australian average, that's an asset that, in quotation marks, outperforms, right? So that's obviously a positive. We're only buying in established locations. So where there is a limited amount of land, you look at Sydney right now, pretty hard to get a block of land unless you go 80 k's west, north or south of the city. So that's obviously a good thing. We look for elements of scarcity. It's different in every location. You're in Double Bay now, small block of 8 apartments, which is probably, all around the streets of Double Bay when you walk around, with parking in an Art Deco block, is very unique with outdoor space. In another location, that would not be unique. So understanding what is scarce in a market and what is not. And then we always want to have the ability to add some value to the property, because that's what we do. We think it's beneficial. We want to be able to increase the yield of an asset, because yields are relatively low in most major regional hubs or major cities around the country, and having 6.5% interest rates and 3% yield, not a lot of people can afford to hold many of those. So they're the main things. And, generally you're not buying the same asset forever. That's also what a lot of people don't get. People just go, there's one way and one way only. The way that I share information around, or the strategy, is not the right way for everyone through all parts of your life. Do you reckon the richest people in Australia invest like Jack Henderson? They use certain fundamentals of how I invest, because I've gotten it from them, but they buy completely different assets. So generally when you're younger, you might be buying different assets to when you start to make more money, to then when you start to have a larger capital base as you move through your investing journey throughout life. Like, you're going to be buying different kinds of assets. And that is true for my journey. I started off with boutique apartments in the eastern suburbs. Then I started to make a bit more money. I could spend a little bit more, so I started to buy bigger blocks of land, things that you could develop in other markets. And now I'm moving into larger commercial assets at 5, 10, 15 million bucks, which I would never been able to buy, when I was starting out. But now I've got the capital and the income to support it. It's a better investment. But for me to say that's the only way to invest, you should only invest in that and then don't invest until you can buy something like that, would be stupid.
What about you, Lachlan? Yeah, it's pretty similar.
You want to come on board as a client now, don't you?
I'm trying reason to argue with that. I can't really argue with that. So
I knew we kind of agree on that. So we'll get to a good debate.
Let's do it.
Actually, what I wanted to show you, actually, Jack, Sorry for the dead air.
No, that's
to
fine.
the
Get it
audience
out. Is this
was-
the reaction?
Let's get the video up of.
Got me
this
fired
is
up.
how
I was
this
ready. I
all
was in the
started.
mirror sparring.
Called out Jack.
I'm like a massive advocate for rent vesting, and it's not because I can't afford to buy
Brave
my own
heart,
home.
huh?
I could buy any house that I
You can just see
wanted
the
to an
polarity
extent.
between
Joanna
us,
lived in was
right?
probably worth 15 million
Very
bucks. It's
sharp.
costing me $3,800 a week to rent, which is not a small amount of money.
I call Jack, and this is the problem with the advice that you're giving to the public. Most often it's incorrect. The primary place of residence is arguably your best strategy for those that are investing in a rising market. There's no other platform where you get tax-free dollars.
We get
Yeah,
the gist.
yeah, we get the juice. Rent vesting versus owner rock.
Correct.
Yeah. Again, there's no right or wrong. You know, in Perth, when you can buy a house for $2, sure, owner rock makes more sense. You live where I live, and it makes 0 sense unless you are spending cash, unless you're buying a property for cash. To live where I live, you're spending minimum $10 million on a house, and if you want something really good, you're spending 15, 20 million bucks on a house. Like, to buy something like that, even if you went in with a 30 or a 40% deposit, to have a mortgage of that size that you're paying for with after-tax income, to be a business owner as well, and if you're a PAYG employee, there is certain ways you can minimise your tax, but you know you are sort of hamstrung to an extent. Having tax deductible debt is a really good way to minimise your tax bill. But when you run a company, anything that you own personally, you have to push out that amount of money to pay for all those personal expenses. So you think about, let's use me as a scenario, and we'll use round numbers. Let's say I earn $1 million net for the year, okay? If I kept that in my company, I'd pay 250 grand tax on that mil. So I'd end up with net 750. The only money I would push out of my company would be money that I'd need to spend on food, living, a bit of living expenses, say rent. But let's say I push out 100 grand out of that, and I pay the top up tax on whatever the tax rate is on the 100. And the rest of the money stays in the company. So now I've paid for my rent, I've paid for my fuel, and I've paid for all the things that I need to pay for, and the vast majority of my money has remained within my company structure. Then from there, I go and invest that money. I'm being way more tax effective on the money that's in the company, because if I pushed it all out to myself as an individual, if I had that big owner-occupier mortgage, I'd pay another $220,000 tax on that.
But you got to pull it out eventually, unless you're just going to sit
No,
in the company.
you pull it out when it starts generating income. So that's what a lot of people don't understand. The only reason we invest in assets is to one day have those assets pay us so we don't need to go to work. That's the truth, right? You don't invest in real estate to sell it one day and have lots of money in the bank and look at it. You always have to have that money working for you. So with your own home, eventually it will be debt-free. There's no doubt about it. But a debt-free home doesn't mean you don't have to get up and go to work, because it doesn't pay you. So one day you will sell that property and then do what with the money? Invest it in something that will give you income.
Yeah, like a commercial asset.
Or anything. Yeah. Most people go through their life, they get the home, they sell it down, they put a big chunk of it into super, they buy an apartment by the beach and they retire. I just do that in reverse. I go, well, I'll rent for a quarter of what it would cost me to own that same property, which means I need to push out less money from my company to myself as an individual to be able to pay for it. Way more of that money stays in my company. I then invest the net amount of money into investment assets that one day I won't sell. They'll start producing me income, and then I'll push it out of a company from an income point of view based on how much I need to live on. If you run the numbers on that, properly run the numbers on that over a 30-year period, the tax saved on the income versus the potential CGT that you would save on a sale of an asset that you will one day invest the money in, they're worlds apart, worlds apart. And I don't say this stuff because it's controversial. I say it because it's genuinely true.
But then I suppose you're not going to caveat every bit of content you put out. But as again, Derek and Shirlene listening to your content.
Des and Shirlene. People in Perth have weird names.
But then, your average Australian, which we often speak to, clearly that's not the market you're speaking to, see that information. They then go and, sell their primary place of residence on that advice, and then go and get an investment and get taken down a garden path and buy in Darwin, for instance, because they're like, rent investing's only strategy. That's where I think that information is misinformed for, I think, the majority of Australians who, in the right market, be that Perth, probably be that Darwin.
But
now.
I don't necessarily think it is the right information either, because, again, it comes down to the outcome that the people want, right? And if the outcome that the people want is income, buying your own home is the furthest place from that. Buying your own home will never give you income. And a lot of people, they don't conceptualize this. They're like, I want to pay my home off to zero. It's a great goal. It's a very, it's like wives' tale, like you can't have any debt, you need to be debt free. But it still never gives you anything. So one day you need to invest to get you the outcome. And the harsh reality is most people wait too long to invest because they don't want to invest while they've got this big owner-occupier mortgage because they have no cash flow.
They take on too much debt for their home.
That's right. So then they get to 45, 50 years old and then they go, 10 years away, we want to retire. How are we going to retire? And most people are attached to their home. Had it beautiful for the last 20 years. So I think that if people took this strategy for a long time, if you rent invest for 4 years and then go this and buy my own home, it doesn't work because you don't get the long tail of the investment. But if you said, hey, I'm going to rent for the next 20 years and with all the surplus cash that I save, I'm going to invest. You could grow a larger portfolio. If you look at serviceability between an owner-occupier and an investment, you can generally service maybe 2 or 3 times more without using structures. If you just used, majors to begin with, then went down the non-bank route, you can grow a way larger portfolio that will one day then get you the outcome, which is it'll grow to a position where you've either got enough capital or it's producing income. And then if you want to go buy your own home, you can. But by that stage, the home that you probably buy will be way different to the one you would have bought when you were in your 30s anyway. Like for financially savvy people, I don't think there's a comparison. There is definitely like this stigma around, and sometimes I get caught up in it. Like I find myself scrolling realestateanddomain.com looking for a sick place in the east. And I'm like, why do you want to do that? It's just my ego getting caught up. I want to go, I want to be in the papers, say Jack Henderson bought a $20 million home. And I'm like, I don't need to do that. I can rent one whenever I want to rent one. And I just keep doing what I'm doing. And I'll be way, way wealthier than what I would be if I had the home. So that's genuinely my take. And do I think everyone should do it? No, because most people are not financially savvy. They're not disciplined. They'll rent vest for 2 years and they go, this rent vesting thing, I just got kicked out of my rental and I'm going to go buy my own home. It never works when you do that, right? You need to be disciplined with it and do it for a long period of time to actually feel the effects. And then once, you might, if you're a business owner or whatever, you might get a liquidity moment and then you can go buy your home.
Yeah, it's probably where we don't agree because I think for many of probably our clients, our listeners, and for most Australians, buying a home, particularly those when you have family, you have kids, you don't want to be, the personal reasons outside what you've just discussed. Like we talk about it on our podcast, various strategies, how to pay your debt off in 5 years on your PPOR, making sure that your debt to income's not more than 3 times because then it becomes very difficult to get leverage to buy investment properties.
Debt to income?
Your debt to income?
Not more than 3 times. No, you wouldn't be able to live anywhere in Sydney. You earn $200,000 a year to buy a $600,000 property.
yeah, to be fair, but 3.5, and then pay that off, so then you can use investments to pay off your debt, right? So, but that
strategy works. You can buy an owner-occupier, you can buy an investment, have that investment get you 50% CGT discount. Fingers crossed it doesn't change, and you use the gains off that to decrease your owner-occupier debt. But then the issue is, no one ever stays in that first house. That's the challenge. They go,
I want to upgrade.
I've got no debt now. I make a bit more money. I want my kids to go to the private school, and they get I just look at. I don't talk about things that are not history doesn't show me. It's like I look at I've got rich friends, right? But they're not rich in a way where they could stop working tomorrow. They're rich where they've got the big house. They've got a $20 or $30 million home. It's in a great street. But if I said to you, hey man, you want to go travel for a year? They can't do that. Because they'd have to sell their house, right? So, and then also the realities of lifestyle creep, and you have a nice house, you live in a good suburb, or your friends also live in a good suburb, they live a certain lifestyle, you live the same lifestyle, you spend all your money. That's just the reality of the world that we live in. We're consumers. So.
Did you start rent vesting? Was that your first acquisition? Because
I
was
a first home buyer. I took advantage of the incentives, but
you're a rent investor.
Yeah.
Because I think I was as well, but at the time it wasn't a thing.
Yeah.
Rent vesting, there's been a big surge.
The reason there's a surge now is because the disparity between what you can rent the thing for and what you can pay for it are two very, the numbers have never been further apart, right? Due to the price growth of assets. That's why it's becoming more popular.
And people can't afford to live the
lifestyle. Yeah. That's right. So it's if they wanted to live in a place that they could afford, they'd live in Bankstown and they don't want to live there. So it's if I can only afford to spend 1.2 million, and people who can buy something for 1.2 million generally earn 300, 400 grand a year, depending if they have other debt. But you still earn a really good salary to buy something worth that value. And 1.2 mil here gets nothing.
Yeah.
So then that's why the rent vesting things become, more of a...
And will become more apparent in the market.
I think so. And you look globally as well, and it is much more common in other markets. So don't get me wrong. It's not the only way. My parents did the owner-occupier thing. They made all their money through their owner-occupier, but they still then got to retirement, which is where they are now, and they had to sell where they were to go buy a smaller house by the water, north of Sydney, and then they put a heap of their money into their super fund, which is what they'll live on?
There was a stat, and we'll have to correct me, it was 5 or 6 years ago, ABS data come out, and a large portion of investors had made money, who owned their primary place of residence and had investment property, had made substantial money, like your parents, in their own occupied, but had lost on their investment property.
That is true to my parents.
And it's most likely true to mine and probably the generation before us. Do you think that is because
they didn't invest like they would buy their own home? That's why I always say, like, the best way to invest is to go and find something that you would live in yourself. And this again is different information to what most investment gurus tell you. You generally will only want to live in a house that you are emotionally attached to. Generally, you're emotionally attached to if you're like in a good demographic. That's in good suburbs, near good schools, near good shops, and all the rest of it. So, like, if my parents would have just followed the way that they bought their properties for their own home, and they just bought the one next door, they'd be twice as wealthy as they are right now. Imagine if they 3 times that, they'd be 3 times as wealthy as they are right now. And that's what I say. It's like, you don't have to use me. Just go buy the same thing you'd buy for yourself, but buy 2 of them.
Yeah,
and you'd be way richer than what you are right now.
Because people don't take shortcuts on where they're going to live, but investment property.
And they always overextend. They always get the best one that they can buy, and they generally beg, borrow, and steal every bit of money they can. Like, no one ever goes, I can spend 1.5, I'll only spend 1.1. No one. They go, I can get 1.5, I'll spend 1.8 and find the other 300. Like, that's generally true for people in their own home.
And then they're slave to their mortgage.
So that's the downside to it. But for business owners and people who have the ability to be really tax effective through keeping the vast majority of their funds in a tax environment which is lower than any other tax in the country, like 25% tax is the lowest rate of tax you can pay on a large sum of money.
Unless you pay no tax on your PPOR, but yeah.
Yeah, but again, that's not an income. That's on a capital gain.
Yep.
So if you are one of those people and you run a business that, you know, makes many, many millions of dollars a year in profit, or even many, many hundreds of thousands of dollars a year, the difference in tax outcome versus pushing that out to yourself as a PAYG or keeping it in your
company,
you know, it could be hundreds of thousands of dollars or millions of dollars per year. And then you compound that over 20 or 30 years. And you imagine if you had, like, I just use that example, $1 million PAYG, you end up with, say, $530 net versus $1 million in a company, you end up with $750 net, right? So there's a $200,000 or thereabouts disparity. You imagine if you had an extra $200,000 to invest every year over 30 years. Well, mate, the PPOR owner-occupier thing's in the bin. Like, that's the reality. So that I think about it, I'm not through the rent vesting. It's like, how do I be as tax effective as I possibly can? Because I make really good money now, and the difference between giving a lot of that to the ATO and not, like, can be 50% variance.
Yeah.
So that's why I do what I do now.
Just on, we've spoken about it, I guess we've briefly touched the sides on location. Rent vesting, you know, the big thing with rent vesting is obviously borderless investing. They're investing outside their backyard in a lot of instances. You said personally you're New South Wales, however the business is, you know, Brisbane and
Queensland, so we're Gold Coast and Brizzy. Yeah,
you're taking a position in Melbourne recently.
We buy a little bit down there when clients want to buy there.
Okay.
So, you know, my big thing with Victoria is the challenge we have in Victoria right now is the leadership. Like, you know, the history has shown us in the last 5 years that they've made very poor decisions around policy. So if they continue to make those bad decisions and they get re-elected into government down there, that's not good for the property market. And the growth in the property market down there at the moment, for the most part, is investor driven because it's affordable. So all these buyers agents are going down there. So I say to clients, look, if you can get exposure to the other markets, I would go there because they're more stable, they've got much better policy. And if the government changes in Victoria and all of a sudden all this shit gets scrapped, like they're trying to legislate work from home 2 days a week and make it illegal not to allow your staff to work from home 2 days a week. Do you reckon that means more businesses are going to want to start there or less businesses? Yeah. Probably less, right? Which is not good for the economy.
But when you say like a market like Gold Coast, I would argue that's far more volatile if you look over the last 30, 40 years. It's like a holiday destination that's been boosted up post-COVID because everyone wanted to leave Melbourne and potentially leave Sydney to go to the coast. I'd say that's certainly a higher risk market than the largest city in Australia, which is Melbourne. There is elements in the apartment market up there, which, you know, were historically holiday let, but the housing market in the Gold Coast has been really consistent. Don't get me wrong, COVID has been good to it, but if you look like well and truly past COVID, it has been a consistent performer. You know, and again, we're investing in good, like really investing in Palm Beach and Burleigh and, you know, more affordable locations, places like Southport and Labrador. They've been consistent performers year in, year out. But houses, we generally don't advise on apartments. But again, the apartments are starting to do really well up there now because there's a massive downsizer market, right? So they're selling out of their $5 and $10 million houses and they want a big apartment to live in, so they're buying the full floory and, you know, in Palm Beach or in Broadbeach or places like that. One of the data sets that we track, and it's the affordability index, which looks at the average wage consumed by the average mortgage. And this is sort of an indicator in our markets when a market's either getting heated or potentially unaffordable for the local demographic, or it's an opportunity where there's, Perth was extremely affordable for the last 5 years and it's closing in. I look at Brisbane now closing in on its affordability ceiling, Gold Coast closing in on that affordability ceiling. Sydney is the highest or the most unaffordable it's ever been. How do you see these markets where the local incomes have never afforded this much debt before? What changes it now in 2026?
So I think, again, that you'll be using local incomes based on, what is it, like a council region or a city region?
Correct. Yep, exactly. Council region.
Council region, yeah. I mean, if you're like Double Bay, you guys are staying there, for example, look at the local income or the average income in Double Bay and then look at the property values. It's not always relative, right? Because average income is not just from homeowners, it's also occupiers of those properties or renters. So definitely in lower socioeconomic areas, that could be a thing. But in areas where, they're affluent, it's not necessarily relevant to, that's not a relevant data track to track the overall thing. So,
but it's going to have some merit, right? Like if you look at, for the markets I've tracked over the last decade, I very rarely have I seen a market, with the exception of Sydney, push past its affordability ceiling, and that's why we've got grave concerns for markets like Adelaide, and for us now Brisbane, it's pushing.
Again, the area, like the challenge, I guess the good and the bad of that data set is that the reason price growth goes well and truly beyond that in places like Adelaide is because a lot of that growth would have been investor driven, not owner occupier driven, and that's why it's so important to be in markets where there is the ability to earn significant income. But there would just be a lot of inaccuracies, I would imagine, because
data can be interpreted in many different ways as well. I agree.
Information. You also, you also don't know the level of debt that people have in those markets. So the statistic around the 10 or 11 trillion worth of Australian property, 3 trillion worth of debt.
Yeah, a lot of people.
7 trillion worth of equity. Whether that's true or false, knows, and who's valued the properties to say it's worth 10 trillion, all the rest of it. If you use CBA desktops, it's probably worth 15 trillion, So, so the thing, it's like there's so many different pieces of data and things that you can interpret. If there was only 3 trillion worth of debt, it's like, the property market can have a huge amount of growth. What happens when all these baby boomers start to die off, and then people that are maybe on lower incomes can get this huge injection in capital? What do you reckon that's going to do to the property values? They're going to have their borrowing plus all the money they've just inherited off mum and dad to spend on property, and that's going to dramatically increase values more. So there's so many variables, and you'd be way more analytical than what I am. I'm not analytical whatsoever. I go, what can you look at around the world, and generally you look at the most global cities where all the wealthy people live, have property values that well and truly exceed anything that you ever thought imaginable, and the reason for that is because they have much deeper pockets than people in poorer places. So invest where the wealthy live, and you should be the beneficiary of that growth.
Yep.
Unfortunately for our listeners and a lot of the punters out there, they don't have that luxury, and I guess that's why we've got to pick the ice with the data and the markets.
What would be your average purchase price of a property?
Just
in general, for clients?
Entry point would be 750 to 1.5. That's broad.
But to say our clients don't have that ability, 750 to 1.5 is a good budget, and you'll get into most major cities around the country, right?
Yeah, but it's those that count that are entering that probably only have 550 or 600 to spend.
I can't help those people. Yeah.
Yeah, and that's where
do you buy for 550, 600?
It's not easy, but I like Geelong, for instance, at the moment. So
where
Geelong, probably don't know. So
Geelong.
It's a Newcastle.
All in 550, 600 in Geelong, or places like Currier, places.
No, you can get a nice villa, like a
villa,
Geelong West on 300 square metres of land. So that for me, it's owner occupier driven. It's close to a large city, be that Melbourne. For me, Geelong's like the Newcastle.
Agreed. I like Geelong as a market. Yeah.
But that's what I'm saying. So that idea of just absolutely, if we could all buy $100 million of real estate in Double Bay, happy days. But for a lot of people, they can't.
Land tax would get you. Land tax. That's the issue.
Yeah,
that's the upside to owner occupier. Is the
no land tax.
Is the land tax.
Yeah.
But there's a way to get owner occupier exposure, no land tax, and not actually have it as your owner occupier property.
We'll talk about that off air.
That was it, mate.
That was it.
Yeah.
Thanks for
coming in.